Okay, talking about Brookfield Renewable. Been super busy, haven't been in the studio as much as I like, but here we go with Brookfield Renewables. Great company, looks fantastic. It's a difficult one to unwind the accounting, and we're going to do our best. But suffice it to say, it's really good, acting really well, things are improving, lots of good things here. Okay, so let's jump into the model, and you will immediately notice the low rate of return. So there's several reasons for this, and I know as an analyst, you know how the model works in intimate detail, and some of the reasons why it would be distorted. And first of all, it's primarily a utility, right? So I'm expecting a low rate of return to begin with, right? I'm expecting, you know, if it does 5 or 6, it's like that's a higher one. This one's only at 3, okay? So, and there are other reasons, not just because it's utility, but also the way that it's a consolidated company, consolidated from other businesses with other businesses other than just the pure utility. So let's go back to this graphic here. And they have a real estate division, they have an infrastructure division, and a private equity division, right? So I'm not going to try and teach a course in consolidated accounting, but let's just say it distorts it. It's making it artificially low in this case, and you know, talk to an accountant that specializes in consolidated companies, because that's what's happening here. And it's just say for this argument's sake, it's artificially low. Okay, the return. Okay. Now, so what can we glean? Well, we know it's improving regardless, right? So that's always good. Relative, it went from 1% up to 3%, and they're putting in more capital. So we know that it's improving, and they're putting in capital. So those are two really good factors. Okay, so that's awesome. We got a 5.18% yield. Let's look at the dividend history. And this is where we start to get really excited. Okay, so the dividend, you know, keeps on creeping up every fourth quarter, it looks like. And the one below is compared to the cash flow, and you see the cash flow is increasing at the moment. Of course, investors love that. Stock's been acting great. It should be acting great because of this. So the payout ratio is very reasonable at 35%. Cash flow is creeping up, more than creeping up, it actually kind of jumped up a little bit. Stock's been acting great. You know, what else can you ask for? High quality company in 4 different high quality businesses, like very stable kind of businesses. 5% dividend yield. That looks very payable, like very sustainable, according to our data. You know, everything really kind of lines up here. Oops, a little off on our. What happened there? Okay, so just, you know, recap there quickly. Great company, good valuation, good dividend yield, good four different businesses, but all really solid. Brookfield's always good. Brookfield anything, Brookfield Asset Management, Brookfield Infrastructure, Brookfield Property Management. I think there's a couple more out there. Literally across the board, I've never seen a Brookfield company that I don't like.